You clicked on this video because you know you're unprofitable and you want to see what you can do, right? You've been all over the internet, all over YouTube searching for things. You've probably bought a couple $100 programs from people who are not profitable or can barely make 500 bucks with some weird indicator. Well, that's not how trading works, okay? But I'm here not to sell you anything, not to wrap you up in a weird VSL into my program, whatever. I don't even have one. But what I'm here to tell you is what metric you need to focus on, and if you dial this in, you're gonna be profitable, right? We're gonna go over it, we're gonna break it down, but again, I'm gonna tell you all this, but if you go into the charts, you act like a toddler, you're like, oh, my psychology, oh no, I can't manage risk, then trading is not for you, okay? Like, if you genuinely cannot get the basic done, then I'm sorry, but you should start looking at something else. Like, genuinely, not even attacking you, I know some people might get triggered, but if you cannot control yourself after at least 2 years of trading, or maybe 2.5, trading might not be for you. Like, yes, it's hard. Of course, it's not easy. That's a lie. But also, to what point are you sabotaging yourself, right? But again, if you start tracking this metric, it's probably going to start getting rid of all those psychology issues, right? Because this single thing, it's not only going to help you improve your win rate, your risk reward, but it's also going to tell you what you need to be doing, what you are not supposed to be doing. That depends on the time of day, on your position size, on your confluences, because this same thing is what Wall Street does and what they track in order to make their traders better. And that's not just a catchphrase. I've literally talked with guys that have worked in New York in the floors. They track this. So let's get over to expected value, right? What the fuck is the expected value? That's an amazing question. So expected value, essentially what it tells you is how much are you going to make per trade, right, in your strategy. But there's different components to the expected value. It's not just a metric. Some people get their trade expectancy or expected value and think they figured their life out. That's not how this works, okay, buddy? So the first metric that's going to go into the expected value is going to be your win rate, right? The second metric that's going to go to your expected value is going to be your average win-loss. So what does this do, right? Well, the win rate, it really is as simple as, hey, you know what, take 20 trades, take your confluences, and then after 20 trades, how many trades did you win? Now, most people are gonna say like, oh, 90% win rate, oh, I have an 80% win rate. Yeah, no, you don't. You're a fucking scammer, okay? Nobody, or at least very few traders, are sustaining win rates above 60%, 65% over the long run. Now, just because you see the, oh, but this guy said 90% win rate, 60% is not as good, let me click off. Okay, if you're thinking that way, get the heck out of my video, right? Because that's not how this works. So as long as your win rate is above a 30-40%, you should be good to go. My personal win rate is like at a 55% ish year to date, so that's pretty freaking good, right? It puts up there. Now, the average win-loss, this is why most traders are never going to make this work, right? Because their average loss is never steady. If you want to actually make it work, and if you want the numbers to pan out and make sense, your average win, yes, it's going to fluctuate, but you need to dial in your average loss, right? Why? Because if you're losing 500, 600, 700, 800, guess what? Not much is going to happen. But if you stay consistent with your loss, right, and you keep steady with your loss, it's going to work. So our average loss, we're going to define it as R. R needs to be consistent, right? Let's say it's 500 bucks. Again, this is only going to work if you use proper risk management. So your average loss is going to be R. Let's say that R equals $1,000 to make it simple, right? You only have one job, right? Is to find your confluences, to execute on your confluences, and to make sure that R is always equal to $1,000. If we cannot get this straight, this video is going to be worthless to you because we're just not going to be able to get anywhere. Now, the average win, right, that can be R. It's going to be R as well, but it's going to be multiplied. R times, and let's just use Z for the variable, right? So Z times 1, times 2, times 3, right? Like, again, if you have it to R, then it's going to be R times 2. So that's going to be $2,000. So we got that dialed in, but how is this going to help me? Well, now we need to look at one thing, right? We know the win rate for the overall strategy, and we know the average win. But that's not all, right? You can't just get your expected value and think it's expected value for everything, right? Because there's a couple of subcategories, right? We're going to find your expected value based on these three things, right? Number one, we're going to find it based on time. Number two, we're going to find it based on position size. And I'm going to explain why this is important, okay? Give me a second. And then number three, we're going to find your expected value based on gamma exposure, right? And I'm going to talk about this at the end because it's a more intricate one. I want to make sure that the people with the TikTok brain get this part first because this is what's actually going to matter first. So based on time, right? So what you're going to do is after your journal, what do you want? Again, if you don't have a journal, just click the link below. It's a free training on how to start a freaking journal. It's the bare minimum you can do. But the time is at what time did you execute, right? I personally like to divide it by 15-minute blocks, right? So if I start trading at 9:30, so between 9:30 and 45, what's my expected value? Between 9:45 and 10, what's my EV? Between 10, right, and 10:15, what's my expected value? So we're gonna find the expected value for time first, right? Again, you're gonna go to 20 setups and you're gonna see, oh, at least for me, my most profitable time is between 9:45 and 10:15, right? That 30-minute block, that's when my expected value goes up to the point of 2.6. Between 9:30 and 9:45, it's like around 1 point something. Before 9:30, it's negative, so I can't be trading before 9:30. It's super simple, right? Now, position size. When I trade with 1 mini, when I trade with 2 mini, 3 mini, right, 4 minis, right, and you're gonna find this, at least for me, I found that whenever I'm trading between 3 and 6 minis, that's when I trade the best, right? And again, this is not more strategy, it's more of you as a trader and your performance as a trader, because what's this gonna do is, right, if you're trading bad with low size, then you know you need to be sizing up. That's how you trade better. Or maybe with high size, you're an absolute degenerate piece of trader who can't do anything, right? So then you should be trading with low size and you should be going on the lower end. And then gamma, if you want to understand gamma, essentially it means how much exposure the dealers have. If we are in a condition of positive gamma, that means that the dealers are hedging effectively, and that means that for every buy there's a sell. You know, the markets are good, the volatility is low. If the dealers have negative gamma, that means that they're hedging more aggressively and they're putting more orders in, therefore the volatility is higher. So if, again, you're just gonna find positive gamma, negative gamma. If you want to know how to see what the gamma is, there's really great tools out there like Mentor Q. So it can be plus or it can be minus, and then you're gonna do the following, right? Again, you're gonna put your R, and then you're gonna see, okay, so if my expected value from 9:30 to 9:45 is, you know, let's say, what's a good expected value? 2, right? And then between 9:45 through 10:30, I see that my expected value is going to be 2.7, right? This is just for the sake of the example. So what you're going to do now is, you know that between this time period, right, 9:45 and 10:30, you're going to increase your R. So let's say that my R between 9:30 and 9:45 is 2, right? So then my expected value is 2, sorry. So I know that my R needs to be lower because I'm expected to make less money. So let's say that my R is going to equal 700 bucks. And because I know that my expected value between 9:45 and 10:30 is higher, then I know that my R for here can equal, let's say, 1250. That's solid, but this is where it gets even better, right? 9:45, 9:30, and 9:45, right? And then let's go to position size. So let's say that when I trade with, I don't know, 1 to 2 minis, right? I have less of an expected value. 3 minis and higher, I have more of an expected value. And then what you're gonna do is you're gonna start sizing heavier during this time, right? Right, so if we know that our expected value from 9:45 to 10:30 is 2.7 R, and we know that we're trading better during high gamma, during positive gamma conditions, we know that we can take our full R, or maybe increase our R, right? Maybe with positive gamma, right? Positive gamma, our R can equal 1,700 bucks. So what you're gonna do, right, again, and this is just assuming you're trading a personal account, or maybe in a profit account you can play with the sizes, but essentially what this is gonna do for you as a trader is it's gonna allow you to have much higher probability of getting those bigger trades, right? You don't need to increase your win rate. You don't need to top tick, bottom tick. Most professional traders don't focus on that. What you need to understand is when you're more likely to trade better, when you're more likely to have a better expectancy, and just play the odds there, right? Because if you're able to actually do that, that's going to give you a better probability of having a positive outcome. Right now, we understand this, and we understand positive gamma, and we understand time and position size, but none of this works, right, if we do not have a proper strategy, right? Nothing works if there is not a good strategy. So what makes a good strategy, right? First of all, we need to understand market mechanics, and this is just my opinion. There's different ways to trade, but at least this is how I've seen the most success personally, and this is, again, the most successful traders I've met, verified 8-figure traders, guys who have worked in New York, guys who have worked, like, they're not trading these weird concept strategies, right? I don't really teach my full strategy here just because, again, I don't want to put stuff out there like that, and I don't even fully teach it privately 100%. Like, I'll tell guys, hey, maybe this, maybe that, but I think there's a point, and this is where it's right, like, if you have something really good, there's no reason to be putting it out there, but that's a completely different topic, and I'll make another video about that, right? But what I will tell you is how to start building your own strategy and how to start looking for the right thing. So market mechanics, right? If you want something that's going to work based on time, based on position size, based on gamma, right? Something that's going to be trackable, you need metrics that are going to allow you to get tracked, right? You need the KPIs. So your KPIs are going to be your confluences. Now, if you want to do, again, if you're taking this approach, you probably like data-driven decisions, and you want to see, you know, the data, the math behind it, then you need to understand order flow, right? So this is how you're going to build a proper strategy, right? First, you're going to learn market mechanics, and you got to understand order flow. Now, within order flow, there's tons of things. There's footprint, there's bookmap, there's everything, right? I personally use bookmap. So, and again, bookmap is just the software, right? But what you want to do is you want to have like a, how to say, like a school of thought essentially, but not even that. It's more like a niche, right? Within order flow trading, there's DOM, there's everything at least. So find your niche and get really good at it and learn everything about that niche. That's how you're going to build a strategy. You're going to build a strategy by knowing everything you can about it, right? So my niche is bookmap. So within bookmap, what do I learn, right? Well, within bookmap, I'm going to learn icebergs. I'm gonna learn stops. I'm gonna learn absorption. I'm gonna learn gamma levels. I'm gonna learn high volume events, right? I'm gonna learn high volume nodes. I'm gonna learn low volume nodes. On top of that, I'm gonna learn passive versus aggressive buyers and sellers. So now that I know everything, then I'm gonna build my journal, right? Again, once I have a strategy, I'm gonna journal everything. I'm gonna take this, and again, my job is not to be profitable at first. My only job is to gather data on how this works. So, and in my journal, right, I'm gonna take all the trades I can, and I'm gonna say, hey, maybe from all the concepts I've learned, right, the ones that are working the best for me are icebergs, are gamma levels, are high volume events, and passive and aggressive sellers. So what I'm gonna do, right, is I'm gonna see what is the expected value when I trade with these confluences alone. What is the expected, like, again, this is kind of like the math thing most people did in lower school, right, where when you have like the table, and you kind of mix and match it up and see, you know, this and this and that, what is the probability, right? So let's say that if I have icebergs, right, icebergs, stops, HV, and P versus A, my expected value is 2.5, right? Over a sample of trades, right? 2.5 EV. And then let's say that this is how you build a strategy. You can't just find a set of confluences, start trading it, and think it works. You need to test out different variables, pair them with each other, right? And you need a lot of stress testing. Back testing is not going to work. That's why I say to everybody, like, if you are not profitable yet, you need to test your strategy, like tape reading, demo trade it for at least 6 weeks. That way you can get as much data as possible, right? But then let's say that I have absorption, gamma, and low volume nodes, right? And that one is giving me an expected value of 1.7, right, EV. And then let's say that I have something else with a negative expected value. So with this data, what I'm gonna do, right, is now after I have this, I'm gonna put it through here. I'm gonna see, okay, well, this strategy, right, 2.5 EV, but at what time? What position size, what gamma? And then once you have all this data, right, once you have accomplished all of them, let me take away this X. Once you have all this data, first of all, good, congrats. It shows that you actually are trying to make something out of trading. But once you have all of this, right, then we're gonna shift over into something even better, which is gonna be building your risk profile, right? Risk profile, que bonito, amazing. What the risk profile is gonna tell us is based on your expected value, right? There's several factors that go into it. EV, right? So you have your expected value, and it is what account are you trading, right? What account, right? By what account, I mean, like, what are the parameters of the account? Is it a live account? Is it a prop firm account, right? So essentially what you need to find is these several different things, right? So first, you're gonna find what is your loss limit, I personally like to do this on a look at this on a daily basis or weekly basis, right? So loss limit, let's say I'm trading a prop firm account. Let's say I'm trading a 150K prop firm account, and it's a funded account. And you know, I'm trying to be a bit conservative and I'm trying to go for it. So my loss limit is going to be $700, right? So then again, going back to this over here, my R is going to be 1,000, or 700 equals R, right? And then my expected value, let's say that for this, let's say again, we got this set up, right? And then at 9:45 to 10, my expected value is at 2.3, whatever it is, right? Just again, throwing numbers out here for the example. So then let's say that my EV is 2.3 EV, right? So then my trade expectancy over here, right? If my loss limit is 700 and I have it, let's say 2.0 EV for the sake of the example to make it easier, and I have an EV of 2, right? Then I can expect to make $1,400 per trade, right? So then $1,400 over a sample of trades, right? And again, this is why it's important to never, like, you need to give yourself at least 10 trades before you blow your account. What I usually do on a prop firm, if I lose 3 in a row, I'll size into half. Like every 3 that I lose, I'll half cut my risk. Because essentially, now that you have this math, you got to do a lot of hard work, and you got to do basic math to see just exactly how profitable are you, how long it should take you, how many trades. Of course, this is not going to be exact, but if you can start getting these numbers and you can start building up this panorama for you, you're going to get rid of all the psychological issues, and you're going to get rid of all that BS that you keep telling yourself, because you now understand the numbers, and you now understand how to play it, and you now understand, hey, if I risk this R over this amount of time for this expected value, I'm gonna get you. And this is the reason why I've been able to make 6 figures in prop firm so far, and it's the reason why I've been able to grow my accounts, and is the reason why some of my mentees, right, again, one-on-one program is closed, but some of my mentees have been able to make 6 figures in a single month as well. It's because humans are never going to beat the market. If you actually want to beat the market, you need to play the data, you need to play the math, and you need to remove the emotions. And the only way to remove the emotions is by leveraging data. Without leveraging data, you're not going to get anywhere. So I hope this video helped you guys. Again, if you want to like and subscribe, please go ahead. Appreciate you guys watching. Bye.